Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're taking a broad look at US consumer stocks, and my guest is Keith Gangl, Portfolio Manager at Gradient Investments. Consumer stocks, it's one label that encompasses two distinct areas of retail. First, staples like food and household goods that consumers simply have no choice but to buy. A fact that gives big players like Colgate-Palmolive a measure of pricing power, which recently boosted their first quarter revenues and profit outlook and their share price. And then there are consumer discretionary items, high-end apparel, durable goods, cars, all much more sensitive to whether consumers can afford to or simply want to spend, especially in times of economic uncertainty. The latest data shows consumption slipping back in February and no change in March as consumers cut back on big-ticket purchases. That was as spending on services rose as customers spent more on housing and utilities. Inflation, meanwhile, shows some signs of cooling, but is still strong. Well, let's compare and contrast the current fortunes of those two sides to this sector with Keith Gangl, Portfolio Manager at Gradient Investments. Keith, we mentioned there are companies like Colgate-Palmolive who've been able to hike prices to battle higher costs. Does that make them a no-brainer from the investment point of view, at least as a defensive play, or are valuations wrong at the moment?
Yeah, I'd be in the camp of more valuations are wrong at this point in time. Staples generally do well when you're worried about high inflation, or a year like last year when the markets are unstable, looking for safety. Staples names are a place to be. This year, we've seen some good reports out of a lot of Staples names. You mentioned, Colgate, there's Pepsi and there's Coke. And they were getting there. A lot of the earnings growth is from pricing, not from volume. So we think that game at some point in time when inflation comes down, the ability to pass on pricing ends. And so those aren't that great of names to be owning at the valuation that they are right now.
One company you like in this space is Target. They have disappointed, though, on several quarterly reports, and their share price has suffered as a result. So why do you like them?
They had too much inventory last year. So they're a mixture. They're a hybrid between Staples names along with actually consumer discretionary. They got apparel and home goods. That was a problem last year. They had too much inventory. It took several quarters to clear out. They've done that now, and we believe going forward, the thing bottoms are in, and the valuation is reasonable at 14, 15 times, where some of those other Staples names we were talking about are trading at 24, 25 times. And Target going forward will have a lot higher growth rate than those other traditional staple names.
US consumers, of course, are famously resilient, but there are real problems out there for consumers at the moment. I mean, you've got a bit of a banking crisis in the US. There have been big layoffs in the tech sector. Inflation is very sticky. So how do investors assess the situation for discretionary stocks right now?
Yeah, there's certainly some headwinds like you mentioned, but the other thing offsetting that is unemployment rates at 3.5%. That's a 50-year low. And with the U.S. consumer, they have money in their pocket. If they're working, they like to spend. So that's a little bit of the offset to some of the high inflation and some of these other headwinds that we have right now. But so again, it's a space we like, but you have to be selective within it.
Let's look at some names you like in this space, some of whom trade at pretty high multiples, like Lululemon. If there is a recession in the U.S., aren't they looking a bit vulnerable?
Yeah, that's possible, but we think the demographic they serve is a higher-end consumer with more disposable income. They recently reported a fantastic quarter. They're not seeing any slowdown in traffic. They're actually seeing an uptick. So with Lululemon, yeah, the price points are a little higher, but there's perceived value there. Consumers like their products. They last longer. They pay up for them. But again, there's perceived value. The customer base has a more disposable income. So it's a name we like a lot. The multiple is not cheap, but you're getting a 20% growth going for the next several years. Their comps are, 25%. No retailer is doing that kind of comp.
Now, two others you like in this space are the diner chain Texas Roadhouse and the growth retailer Five Below. Take us through those.
Now, some of the headwinds for Texas Roadhouse you touched on a little bit earlier. You have high inflation, you have some labor cost issues, but we think they can manage through it. This company is growing their EPS mid to high teens. That's going to be the next several years. We think they could pass on this inflation because their price points were lower than a lot of the other steakhouses out there. Five Below is a great concept. Now, that's on the other end of the demographics. They're looking at a lower price point. They have 1,200 stores. They can get up to 3,500 stores. Again, their square footage growth. And you can see that theme we like. We like stores that can grow. A lot of retailers are in the mode of no growth to negative growth. Texas Roadhouse growing, Five Below growing. Those are the kind of names we like, all growth concepts.
OK, Keith Gangl, Portfolio Manager at Gradient Investments. Many thanks for your insights today. And that is your look at investing in US consumer stocks. I'm David Pollard, and this is Reuters.